In this presentation, we will take a look at standard costs. Standard costs are preset costs for delivering a product or service with normal conditions. So they're going to be the preset cost, the cost that we are in essence kind of budgeting or planning what we would expect to happen if under normal conditions. Note that as we put together the standard costs, it's going to be an estimate into the future. So we're projecting into the future or estimating what the standard cost of some component should be. To do that, we're going to need more than, of course, just the managerial account. We can't just look at last year's costs and say that's what it's going to be. We're going to have to project it into the future. We might take the last year's stuff into consideration, but we're going to have to put a team together in order to figure out what we believe the standard cost should be, because we're talking about things like the production of items, and that's going to be outside of obviously simply the accountant's department. So we're going to have a team that could include things like the engineer, the production manager, human resources, and managerial accountants all getting together to kind of figure out what those standard costs should be, what basically our projected number should be for under normal conditions for a certain process, certain procedure, certain component of the production process. Then, of course, we can use those standard costs for budgeting purposes, for measuring purposes, for performance purposes. That's our goal here. You're imagining us basically putting together how long something should take, or what process something should go through, what the cost should be of it, and then comparing the standard costs to the actual cost. So we're going to say this is basically what we think it should be. Here's what actually happened. We will then, of course, look at the difference or the variance, and we will consider what that difference is, if it's relevant material difference, and then go into any decision making or changes about the way we either made the estimate or what we're doing in the process so that we can improve. These will, of course, be some types of estimates. So we're going to be looking at those differences that are significant. We're going to be looking at the most significant differences because those we would think and assume would be the most relevant differences. These standard costs will often, of course, be used to create the budgets. We'll often come up with the standard costs, which will be kind of like the components of some of the line items that we'll be using within the budgeting process. And therefore, when we consider the budgeting process, you'll note that we have line items such as income statement type items, which we may further break down into their standard costs. And that allows us to have the component parts of it. And when we do our comparison of our actual numbers on the budgeted financial statements to the actual financial statement, what actually happened, we can then take those differences and those variances and break them out into their further component parts with the use of the standard costs. If we consider things like standard costs, we might imagine somebody basically taking a stopwatch to the production item. So for example, this is going to be a phone. If we take these component parts of this phone, and this is going to be our worker here, and this is going to be our managerial accountant that's going in and is trying to say, well, how long does it take to make each phone? Because what we want to do is break down the process of the making of each phone to a certain amount of time, and then see how much the cost of labor should be per phone. And we're going to break it down to that level of units. And once we have that, then we can use that to make estimates and calculations. So in other words, we put together the components to the phone, stopwatch, how much time should that be? And then we can kind of predict what the cost in terms of labor hours should be for each component part in some fashion like this. So this is where you can imagine basically you've got the people in the production areas with stopwatches trying to figure out and time everybody and see exactly what the processes are for everything so that we can come up with those standard costs. As we do this, you might imagine that if someone goes in there and starts pulls out the stopwatch and starts measuring us, then we're probably going to come up with ideal times in that case, because we're going to feel under pressure. We're going to do the best job we can, most likely. And so note that if we make our projections based on ideal standards, then we're never going to be able to reach those projections, because of course this worker here, as they put things together, it's going to have fatigue. At some time they're going to slow down, and sometimes they're going to go to the bathroom at sometimes and whatnot. There's going to be normal things that happen. So note that as we go through this process and go through the stopwatching process, we could use the ideal standards and then just kind of note that of course there's going to be variances. We're always going to be under the ideal because that's going to be ideal conditions. And there's always going to be other things that are happening that are going to slow down the ideal. and or we can have the practical standards we can kind of try to accommodate in our calculation from the ideal to what we think would be a reasonable practical standard based on our analysis. So we can basically use our stopwatch, get the ideal standard, and then try to somehow work in what we would think would happen with fatigue some way and breaks and things like that. So most organizations would probably look for a practical standard and not use the ideal standard so much, because we could use the ideal and then just note that we're not going to hit it because it's an ideal standard, and just be aware of that. However, it could be a little bit discouraging if that's the case, if we have basically the ideal standard that we know we're not going to hit. So many times the practical standard could be something that could set a benchmark that might be more appropriate, because of course then we can have a benchmark that people have a chance of achieving, and that would be often more useful. Remember that when we think of the production of inventory, we have the component parts. We've got the direct materials, we've got the direct labor, and we've got things like the variable overhead. These are going to be the change. So materials, labor, and overhead. We're concentrating here on the variable overhead. Note that as we look at these components, then we can break these out into their further parts. So in other words, if we look at a contribution margin type of income statement, we will see a line item for direct materials. If we have some variance or difference from the actual to the budgeted number with regards to direct materials, we can break that down further into its component parts, that being the price standards and the quantity standards. So note that the difference on the comparison of the budget to actual financial statements, the budgeted income statement to the actual income statement, won't break it down as much as we would like, because we can then take that variance, that difference, break it down into its components. In other words, is it the price of the materials that caused the difference, and or is it the quantity of the materials that were used? Did we use too many or too few materials? So the materials, the direct materials will then be broken down into the component parts of the standard costs of price standards. What's the standard price for the material? And then quantity standards. How much does it typically make or take of a material to make a unit? We have a similar condition with the direct labor. If we consider the direct labor on the income statement, the budget versus actual, we see that difference. We want to further break that down into its component parts, and we'll have the standards of the rate standards and the time standards. So if we break down to the standards, we could say, okay, there's a difference in direct labor expense on the budget versus actual on the income statement. Well, is that due to the difference in rates? Did we pay people different rates than we had expected, comparing the standard to actual rates? Or was it the time standard? Did people work more or less hours than we had budgeted them to do so? So we had the standard time standards, the budget versus actual. And then the variable overhead, we have a similar kind of condition with terms with the variable overhead. We have the rate standards versus the activity standards. So note, again, we can take these component parts, we can take these pieces that will be on the budgeted financial statements, and we can further break them down, and we'll use these tools to do so, and that will give us more information to go and say, okay, where is the specific area that we can go into our system and improve? Because we'll know a better idea of where the improvement is needed.